What does this divergence tell you? What does this huge spread tell you?
Hello there, Alex. Good to talk to you again. Well, I was looking at the different sectors and sub-industries in the different indices within the S&P. I look at the rolling 12-month relative strength to see if I could spot some top outs and turnarounds. And when I looked at energy, I was amazed to see that whether you look to the cap-weighted 500, equal-weight 500, small-cap 600, or global 1200, that the energy sector is trading at the lowest level that it has in the index's history, going back either to 1990 for the global 1200, 95 for the 1200, and 95 for the small caps, and back to 1990 for the S&P 500. Lowest level, both were all were trading at below 2 standard deviations from the mean. So the impression was that if you believe in reversion to the mean, that over the longer term, these could be good buying opportunities right now.
Yeah, Sam, make a distinction for what stocks look most attractive, because there is something fundamentally different about this decline in energy stocks, and that is shale, which continues to be a wild card throughout the energy community in terms of how much it can produce for how long.
Oh, sure. Well, there are a whole variety of companies that are found within the energy space. You know, they are the upstream companies that are most responsive to energy prices. You have the downstream companies, refiners, which are also very responsive to a reduction in prices. And then you've got the integrateds, which basically have a little piece of everything. I would tend to say that those companies that are more closely aligned to the upstream, especially the onshore upstream, are the ones that are not going to do that well. However, if you look to companies that are engaged in offshore activities, FTC Technologies is one in which it is a deep water equipment and services company we think should do relatively well. Rowan Companies is one that is balanced between shallow and deep water drilling activities we think should do relatively well. And Valero Energy, because of the refining aspects, it brings in very low cost energy, but at the same time is benefiting from the higher cost gasoline.
So basically, I should point out that FTI Technologies basically kind of makes robots that work on the bottom of the ocean. It's actually pretty cool. One part of the energy space, however, is the amount of debt that these companies have had to take on. Drillers' debt in particular has ballooned to about $235 billion at the end of the first quarter. That's a 16% increase from last year. How do you factor the debt and the interest payments into your models?
Well, certainly when we look at the individual stocks, all of those factors are built in. When I was looking at the relative performance, looking at the entire group, realizing that energy itself is not going to be a sector that's going away, and also realizing that it's part of a broader strategy. I published just recently what I call my free lunch portfolio, which looks at those sectors with very low correlations with one another that also represent when they perform best in an economic cycle. Technology being an early cycle performer, consumer staples being a defensive early contraction performer, and energy being a late cycle inflation hedge, and finding that having equal proportions of all three sectors going back to 1990 for the large caps, 95 for the small caps, and global, you outperformed the market by an average of 300 basis points and did so about 2 out of every 3 years. So looking to update that based on whether, if you're afraid of jumping into energy now because it's exhibiting the glide path of a crowbar, by using technology and staples as water wings, if you will, then maybe you'll be willing to jump into the pool.
So basically you're saying that's how you minimize risk when you're taking energy as a longer-term late cycle play that's more levered to inflation. Is that what you mean by minimizing the risk?
Well, minimizing the risk not only by realizing where it does best in the economic cycle, but also offsetting it with sectors that also have very low correlations to one another, so that depending on where we are in the cycle, and sometimes we really don't know where we are, by having, in a sense, the 3 points to this plane of an economic cycle, that you can end up outperforming the market just by having equal representation in those 3 sectors.
I love that. That's really, really fascinating. Do you have any calls on more of the upstream plays? I mean, you did mention the refiners, the technology. Would the upstream companies like a Continental, which has major shale exposure, for example, be sort of something you want to avoid?
I think you do have to be very selective when you start to, pun intended, drill down into some of the individual stocks. Because let's face it, these stocks have been beaten up so badly that there will be an awful lot of overhead resistance for when they do start to recover. A lot of people getting out when they get back to break even, saying, I want to dump these dogs and move on to something else. So if you're going in the individual stock route, I think you need to be very selective, companies like I mentioned, but if you are going the ETF route, then I would diversify by putting on those water wings of tech and consumer staples.
Good stuff. Thank you so much, Sam. I love a kind of contrarian call there. Sam Stovall, an equity strategist at S&P Capital IQ.